Good morning to all. Welcome to my channel. Today we will be discussing under standard costing and variance analysis, that is overhead variances. You see that in my earlier two videos I have given separately your material variance and labor variance. So this is the third constituent of your production cost, that is material, labor and overhead. Overhead is the third constituent of your production cost. So this variance analysis also very much important for your production cost control purpose. So to start with that, we take an example for your fixed overhead variances. A manufacturing concerns as the following these informations relating to fixed overheads. You see that standard actual output in a month 5000 units and actual is 4800 units. Working days in a month 25 days and 23 days. Fixed overhead 5 lakh per month and 4 lakh 90,000 per month. Generally, four types of overheads we have to calculate under our overhead variances: fixed overhead variance, fixed overhead expenditure variance, fixed overhead volume variance, fixed overhead efficiency variance. Now we'll be going one by one. What are those variances? First, we'll discuss with the overhead fixed overhead variance. That is very simple: standard fixed overhead minus actual fixed overhead. So how will calculate the standard fixed overhead? That means first of all you have to identify your standard fixed overhead standard cost divided by standard unit into your actual unit. So that is the standard fixed overhead you have to calculate. So again we are repeating, standard fixed overhead how we will be calculating? Total fixed overhead, standard fixed overhead divided by number of output, standard output into actual output. Taking the resultant figure will be your standard fixed overhead, and actual fixed overhead already given in your problem. So now you can see here, you see that your standard fixed overhead comes to rupees 4,80,000 and actual fixed overhead comes to your 4,90,000. As in case of other constituents, material and labor also, here also you can see that the figure difference 4,80,000 and 4,90,000, your 10,000 is whether it will be favorable or unfavorable variances. Now you have to understand that always in costing concept, if your actual cost is more, then the difference will be your adverse or unfavorable. So you see that standard fixed overhead is 4,80,000 and your actual cost is more than that, then it is an unfavorable, that we can call technical terms it is an adverse. Okay, so now next, that is our fixed overhead expenditure variance. So fixed overhead expenditure variance, what is the formula for that? Budgeted fixed overhead minus actual fixed overhead. So budgeted fixed overhead, how much? It have been given your budgeted 5 lakhs, it has been given, and actual fixed overhead is your 4,90,000. You see that here your budgeted fixed overhead in comparison that your actual fixed overhead is less, that means your efficiency is there, then it will be the difference, that is the overhead variance will be favorable. So always actual, if it is less than budgeted or standard, then it will be favorable. So this is the two variances we make it. Now we will be coming for these things. Other two variances, those are we will be discussing for that. The third variance being your, what they are asking for, fixed overhead volume variance. Fixed overhead volume variance. So what is the formula for fixed overhead volume variance? Standard fixed overhead minus budgeted fixed overhead. Budgeted fixed overhead. So what is your standard fixed overhead? Here standard fixed overhead, you have to see that in our earlier calculations we have made it the standard fixed overhead is 4,80,000. You remember that earlier this number one, the standard fixed overhead is 4,80,000 and your budgeted fixed overhead is your 5 lakhs. So if it is your standard is 4,80,000 and budgeted fixed overhead is 5 lakhs, so there this 20,000, whether it is your adverse or favorable. You see that budgeted fixed overhead, with that your standard is, that means standard fixed overhead is less, then it will be adverse. So again we are repeating that 4,80,000, how it is coming? You remember that 5 lakhs your standard fixed overhead divided by your standard units 5,000 into your this actual units 4,800. So it is the standard for actuals, practically standard for actuals. So this is the thing. So this 4,80,000 is coming, right? So now we will be going for your another variance, that is your fixed overhead efficiency variance. Efficiency variance. What does that fixed overhead efficiency variance means and how to calculate for that fixed overhead efficiency variance? So here formula is standard fixed overhead minus budgeted fixed overhead for actual days. Remember. So this formula you have to carefully remember that. Then here standard fixed overhead, you understand that in your earlier this thing standard fixed overhead is your 4,80,000 minus budgeted fixed overhead for actual number of days. You see that your standard fixed overhead is 5 lakhs by your working days your 25 into here this actual days is 23. So here the total figure will come 4,80,000 minus this figure will come your 25 into, that means 4,60,000 will come. 25 into 2, 20,000. So 4,60,000 it is coming, right? So difference is your coming is 20,000. Now question comes whether this variance is favorable or adverse. You see that standard fixed overhead, budgeted fixed overhead for actual days. You see that. That means this is relates to budgeted fixed overhead for actual number of days. So since your actual number of days is less, definitely your figure is coming less. So this variance will be your favorable variances. That means from here itself, working days in month budgeted you have made it 25 and actual days in the same productions per related to that 23 days. So definitely your expenditure will be less. So here this 20,000 is the favorable variances. You see that we are repeating in your, even in your material variances or labor variances or your overhead variances, see result will come either plus minus 10,000, 20,000 variance will come. Only thing very important, whether it is a adverse variance or favorable variances. In respect of standard with actual, since it is a not revenue, it is a cost. So always you have to think over whether cost is less in comparison to your standard or budgeted. So that is the clue point for selection of your this your favorable or adverse. So today हमने वो जो standard costing and variance analysis का third constituent that is overhead complete किया. So you can see my that material and labor variances in my other videos or description box में we have given that link. You can see that thing. So हमने आज के लिए इतना ही discussions कर रहा हूँ. So कोई भी आपको if you have any doubt you can give your suggestions and we'll try to clarify the same. One request I will make it. Please do subscribe to my channel so that whatever videos will come for your BCom, BBA, MBA, CA, CMA, whatever the course you are, all the your subject related videos are regularly coming to my channel. So please do subscribe. Once again, we are ending this video here. Have a good day.